Hello, welcome listeners and market participants to KBRA's European Credit Podcast, Conversations in European Credit. I am Gordon Kerr, Head of European Research at KBRA, and today I'm joined by Killian Walsh from our ABS Ratings team.
Hi, Gord. Thanks for having me on again.
It's great to have you, Killian. In this podcast, we will cover a topic that's been a dominant discussion point within European securitization markets, but is now becoming a growing segment of the market in the US as well. This is the reverse of typical product innovations in the past, where it tends to go the other way across the pond. The product is what is referred to as a significant risk transfer, or sometimes a capital risk transfer, or synthetic risk transfer, or even capital relief transaction. In all cases, the acronyms end up the same as either SRT or CRT, but whatever you refer to them as, we have you covered, and have commented on this topic regularly with a number of publications and several past conference recaps. So, Killian, let's get started and dig into the topic. Now, financial institutions utilize securitization as a tool to manage credit risk, liquidity, and capital by transferring a tranche portfolio of risk to external investors. SRT transactions are a form of securitization, and they optimize capital requirements for financial institutions by reducing risk weightings assigned to the portfolios of loans that are held on their balance sheet. These transactions have experienced healthy volume growth globally in the past few years. Growth and expansion of the market is expected to continue as we lead up to and after the implementation of the Basel III regulations. As financial institutions seek to optimize capital by reducing risk-weighted assets assigned to loan portfolios, they have several options. They can approach the capital markets for equity, or they can find alternative sources of capital, like SRT. So, Killian, let's start with the basics. What is the basis of an SRT transaction?
Thanks, Gordon. As you highlighted, the primary reason for these transactions for financial institutions and banks is to obtain capital relief. Banks and financial counterparts utilize SRT transactions to transfer potential credit losses associated with financial collateral to third-party investors. An SRT structure involves a protection buyer, i.e. the bank or the financial institution, which allocates the credit risk associated with a reference pool of assets across multiple tranches, similar to typical securitizations. The protection buyer transfers the risk associated with one or more tranches through guarantees or derivatives, such as a credit-linked note or a credit default swap. The transfer of the risk can occur directly or via a special purpose vehicle to the protection seller, namely the investor or the risk taker in the transaction. In transactions that issue credit-linked notes, the issuance proceeds are either deposited in an interest-bearing cash collateral account or transferred directly to the protection buyer. If the tranches associated with the notes incur losses, the cash collateral account will be used to make loss coverage payments to the protection buyer. The remaining balance of the cash collateral account will be used to redeem the note at maturity. Entities also provide uncollateralized protection in what are referred to as unfunded transactions.
Thanks for that. We'll come back to the details of how a transaction works later, but for now, let's cover the topic of why these have become such a hot product at the moment, a scramble for capital. Ever since the global financial crisis, banking regulations have been increasing the amount of capital that needs to be held by banks in order to make the financial system more secure. The latest and potentially last iteration of this is referred to as the Basel III Endgame. This is another step up in capital requirements that is needed by the banks. So what is the latest that is happening on this topic?
Well, in Europe, most banks have been raising capital over the last several years through this technique and others, and are reasonably well prepared for Basel III. However, in the US Federal Reserve Board of Governors published proposed revisions to Basel III Endgame in July 2023, following a period of stress for US banks, which included the failures of Silicon Valley Bank and First Republic Bank. The proposed revisions included substantial increases in capital requirements for mid-sized and large banks. After widespread market input, the Fed released a re-proposal on September 10th, which tempered some of the increased capital requirements. The re-proposal may still be subject to further changes as the market continues to provide comments and feedback.
So what's in the proposal?
In the most recent proposal, global systemically important banks will need to increase their common equity Tier 1 capital requirements by 9%. For other large banks, the proposal will adjust the inclusion of unrealized gains and losses in their regulatory capital calculation. This will potentially increase their Tier 1 capital needs by an estimated 3 to 4%. For smaller US institutions, still subject to capital requirements will increase by about 0.5%. Further, the Fed will also make adjustments to the risk weights for residential real estate and retail exposures.
And what about in Europe? Has there been a reaction in regards to that?
But both the European Commission and the Bank of England are also expected to increase capital requirements. However, both delayed the implementation of their rules while they await the final proposals from the US. The EC delayed this by 1 year, and the Bank of England delayed by a further 6 months, what is existing. Despite the recent developments, US, EU, and UK are all fully expected to fully implement deployment of the new rules by 2026, which will further promote issuance as banks look to increase capital. Although the European and UK banks are already well advanced in their readiness for Basel III Endgame.
Okay, so let's maybe touch a bit on how the market has developed. A lot of this is covered in more detail in the report, but maybe you can just give us a quick overview in terms of the way that the market has developed.
Sure. On a top level basis, the SRT market has been expanding since 2014, with, for example, in 2022, over 100 deals executed globally. Growth has occurred across various asset classes and geographies, including the US, since 2019. Volume growth peaked at 225 billion by portfolio size in 2022, before tapering off to 153 billion in 2023. Year to date, as of 2024, June, activity is relatively low, which is typical as the predominant quarter for SRT issuance is the fourth quarter, as financial institutions seek to optimize capital for year end while not paying unnecessary premiums during the year. Overall, deal count is expected to return to levels similar to those in 2022. In 2022, there was a total of 111 transactions, and so far in 2024, we had 34 as of June, and it has been growing ever since then.
And you mentioned the variation in collateral. What is the typical collateral type in an SRT transaction?
Well, looking since 2017, when I suppose SRT transactions became more prevalent in the market, corporate and SME loans have constituted nearly 57% of their total reference portfolio amounts in SRT transactions. This is likely due to their higher risk weighting on their balance sheet and therefore provide the greatest capital benefit. Namely, they are the low-hanging fruit for SRT transaction. Other large sectors of collateral are consumer loans, auto loans, and mortgages. The number of other smaller sectors like trade financing also utilized as collateral. We ourselves have been involved in rating a wide variety of transaction collateral.
Thank you for bringing up the ratings angle. Let's get into more detail now on the deals. These transactions in Europe are typically private and so not rated, but some of them can be rated either privately or publicly. And we have been involved in a number of transactions over the years. Can you give us a quick overview of what a deal looks like?
Yeah, obviously it'd be easier to do this visually, so it'd be good for listeners to have a look at our report. However, let's say a bank has originated a large consumer loan portfolio with 100% risk weight assigned for regulatory purposes. The portfolio is segmented then into three tranches. First loss, namely the expected loss tranche, between 0 and 3%. A mezzanine, i.e. covering the unexpected loss between 3 and 20% tranche, and a senior tranche, 20 to 100%. The bank retains the risk associated with the senior and the first loss tranches. Credit link note in these transactions is issued to an external third-party investor, i.e. the protection sellers, to transfer the risk associated with the mezzanine tranche. The proceeds in the rated deals we looked at are then deposited in a cash collateral account. If losses, as defined under the transaction documentation, occur in the reference portfolio, the cash is deducted from the cash account to compensate the protection buyer. Loss and principal amounts of the notes is written down. So in this example, first 3% of losses are absorbed by the bank as it retains the risk associated with the first loss tranche. But then losses exceeding 3% and up to 20% are absorbed by the third-party investor, protection seller. Should losses go even further, which would be unexpected and it would be a rather extreme scenario, and exceed the 20%, These are then borne by the bank as it retains the risk associated with the senior tranche. The protection buyer pays the protection seller a fee or a coupon for assuming the risk of potential future losses. In our example, the note coupon includes the interest earned in the cash collateral account and the proceeds from the protection fees paid by the bank. At maturity, the remaining balance of the cash collateral account is used to repay the principal amount of the credit-linked note.
Perfect. Thanks. Now, what are the important considerations when you are looking at one of these transactions?
Well, there are a number of elements that we take into consideration, very similar to what we would do with any structured finance transaction when specifically looking at SRTs. There are four main ones that are key. Of course, we analyze the underlying assets. Here, the credit quality of the underlying asset will influence the overall performance of an SRT transaction, as loss expectations for the reference portfolio would likely be similar to the same asset pool if it was securitized in a true sale transaction. However, the defined credit events in an SRT may differ from those in traditional securitizations and have a bearing on credit performance. These credit event definitions and triggers are typically negotiated on a bespoke basis and agreed between the issuer and the investor. Next, we need to consider the issuer quality. Like traditional securitizations, where the portfolio of assets is typically sold to a bankruptcy remote SPV, synthetic or significant risk transfer transactions usually do not involve a sale of the underlying asset. Instead, a reference portfolio of assets is segmented into tranches, and the issuer continues to service and control the asset. Further, the issuing bank typically makes the payment due on the note. In some transactions, there is inherent credit risk to the issuing bank since the credit-linked note issuance proceeds are transferred to the bank and those proceeds are used to pay principal. Furthermore, credit protection fees are also payable by that bank.
Great. Those are clearly the biggest and most obvious, but what about the other two you mentioned?
Well, I think the other two are more rating specific. When we see defined elements of SRT transactions that need to be considered from a rating perspective. And we've seen a number of and two specific structural features developed in recent transactions that we've analysed. First one is the deposits that are typically placed with a third-party bank. In response to recent bank failures in the US, several US transactions have included a new feature whereby the issuing bank deposits the note proceeds with a third-party bank and pledges its interest in that account. This arrangement is expected to maintain a first priority security interest in the note proceeds in the event of a failure by the issuing bank and mitigate in some way the risk of the underlying note principal from getting trapped in the bankrupt estate of the issuing bank were it to fail. The next structural feature that we've seen is the use of third-party letters of credit. And this is to deal with the instance where the issuing bank typically makes protection payments due on the notes. As we look at timely interest payments, these would then rely on the credit quality of the bank. To mitigate this, in recent transactions, we have seen banks and financial institutions use the issuance of third-party letters of credit, so as the rating agency and others are not looking solely to the issuance banks for the payment of timely interest, or in this instance, the timely payment of the guarantee fee or protection coupon.
Many thanks, Killian. That was all very interesting and helpful, I'm sure.
Always a pleasure, Gordon. Thanks for having me on today.
As we have heard today, SRT transactions are a growing part of the strategies of banks. Regardless of how the Basel regulations are implemented in the future, the demand for efficient use of capital by banks across the globe will remain. The use of SRT to manage balance sheets, capital requirements, and risk management will continue. An investor market has developed for the product, and KBRA expects the market for the product to expand further. The pace of this growth remains a question dependent upon the final regulatory requirements. That's it from us today. As always, we hope these conversations in credit help to illuminate the many trends taking shape across the markets. For more in-depth coverage of the themes discussed today, or to learn more about our unique approach to credit, sign up to KBRA's website to read all of our research. Have a topic idea or comment you'd like to share? Reach out to me or Killian on today's episode. Be sure to rate, share, like, and subscribe to this podcast so you can be notified when new content is available. Invite your colleagues as well. We'd love to count you all as informed listeners. This is Gordon Kerr thanking you for being part of the conversation. Take care, everyone.